Good morning, Pranav ji, and good morning, everyone. I, Satish Goyal, on behalf of Shastra CP Study Circle, welcome you all. And let us have our ICI motto song played first. Thank you. Once again, a very warm welcome from Shastra CP Study Circle. Friends, we have with us CA Pranav Jain ji, who is a fellow member of ICI in practice with over 22 years of experience in audit and assurance both in India and abroad. He has completed certificate course of ICI on IFRS and forensic accounting and fraud detection. Presently, senior audit partner with BJC and Associates LLP, chartered accountants with offices in Delhi, Mumbai, and Udaipur, and he is heading the quality and assurance team of the firm. He has authored a book, Audit of Financial Statements, which has been published by Taxman, a regular speaker on various forums, and empaneled as technical reviewer with Quality Review Board set up by Government of India. A special invitee to Auditing and Assurance Standards Board and also Accounting Standards Boards of ICI for the year 22-23. He has been a part of various study groups of ICAI to develop guidance notes, implementation guides, and other technical literature. He has led audits of listed and unlisted companies and has served domestic, international, and multinational clients operating in diverse sectors. Friends, let us welcome Pranav ji once again with applause.
Thank you.
And having read his profile, we could see that he's a great personality serving not only us but the ICI at large. And today he'll discuss with us all the provisions of CARO which we are to implement in audits of all the companies, private limited and limited companies. So without wasting time, let me request Pranav ji to start his deliberation. Pranav ji, please.
Thank you very much, Satish ji, for very warm introduction, and welcome all the participants who are attending this CP program, Shastri Nagar CP Study Center. So I will be, taking all the clauses of the CARO, but primarily I will focus on the changes to CARO, which are significant from the earlier version of CARO. So just a question before we start. I mean, how many of us have actually, drafted CARO report under the new CARO 2020? Any experiences that the participants can share? What has been the experience?
And members can share the answers on chat box, please.
Yeah. So because listed company audits are already over, and I think some of the private company audits are also in progress. So any experience of implementing CARO 2020? So let me share my screen. I think nobody has yet experienced CARO 2020. So, I have, finalized around six CARO reports, the new CARO 2020. Uh, First time when we start doing it, it was really challenging. Some of the clauses are really challenging. We will see because each entity, has different circumstances, facts. So, it cannot be a standard reporting. So, you have to, certain clauses, you have to think a lot. So there's one question. Caro has some issue for stock statement. So can you elaborate, Vishnu? I mean, like, what exactly is the question?
Vishnuji is in job and he is, I think, he's joined Shastra Study Circle for the first time.
Okay.
So this question must be from the auditee side. Vishnuji, please elaborate your question. Rather, your statement.
Let me share my screen first. So is my screen visible?
Yes, sir.
Okay. So what I could understand from his question was that, is there any requirement for verifying stock statements? I think this is the question, Vishnu. If you can type yes or no in the chat box.
Or basically the major question regarding stock statements, that a big issue with the stocks, whether to actually go and verify from the bank.
Yeah.
We need to verify that whatever stocks or debtors and creditors submitted to the
Yeah.
bank,
Right.
at least quarterly, whether it tallies with books of account or not, and
Right.
whether books of accounts includes stock records and all. So
Right.
this may be few questions regarding stocks.
Right. So we will have a look at these aspects when we come to the relevant clause. I think two participants have raised hand, Sanjeev ji and Raj ji. Any
Sanjeev
questions?
ji, if you really want to come in person, please let us know in chat box so that we can invite you and you can come with your voice or video if you want. Or it may be that you have by mistake raised your hands. So please, yeah. Vishnu ji has asked, we make stock statement for bank monthly basis. We take sales as gross figures, not taxable figures.
Right. Okay. So it is not talking, Caro is not talking about sales figure. So you have to give a statement of inventory and debtors that you file with the bank. That is relevant. Sales has really got nothing to do with the Caro reporting.
So what I could understand from his statement is that whatever bank stock statement is submitting to the bank, they are including inventory at market price, not at the cost price.
Okay. Okay.
And he's asking, do we mention in CARO, we take sales as gross figure, not taxable figure? Acha. So what they're saying is including GST and all they're giving to the bank as
Yeah. So,
their sales, not the basic price.
right. So you are taking as gross figure, not tax. Right. So basically, if you talk about inventory valuation, it has to be cost or lower of cost or NRV, whichever is lower. So if you are not including GST, that is fine. There has to be gross value only because that is would be a cost of inventory basically. And if you are including margin in this stock statement that you are filing, then actually you are overstating the stock statement. So you should, the stock statement should be valued at cost or NRV.
Yes.
So let me begin. I think. Right. So first we must understand the background for introducing CARO 2020 because if we see there have been significant enhancement in the reporting requirements. So we had CARO 2003, then we had CARO 2016, 15, then 16, and now 20. So all the 15 was applicable only for 1 year, and then 2016 came in, and now 2020. So the background basically is there has been a significant increase in cases of fraudulent financial reporting. What the regulators found was that there are certain things which the auditor should have verified and reported in his audit report, but has failed to do so, resulting in misstatement of financial statements or of fraudulent financial reporting. So they identified a few areas which they felt were of key importance to the regulators and various users of financial statements such as banks. So they have, brought in those requirements in CARO for the auditor to specifically report about. Parallelly, there have been similar changes in Schedule 3 also. We will discuss briefly about that. There were increased defaults and repayments of loans to banks. So the question that we began with actually the stock statement. So there were cases of overstatement of stock and debtor statement to increase the drawing power, and whereas the actual stock were much low than what was reported, which was resulting in default to repayments of loans to banks. So there were obviously collapse of some large corporations despite no red flags and going concern raised by the auditors, which triggered into a reporting on material uncertainty regarding repayment of liabilities. We will discuss that clause. That's clause 19. Then strengthening the role of internal auditors. So the regulators felt that a statutory auditor is responsible to some extent, but at the same time, where the company is required to have an internal auditor and is having an internal audit function, but the internal auditor is also not raising red flags. So they wanted the internal auditor to also have some responsibility, and they did this through the reporting in the CARO, where the statutory auditor has to comment on the internal audit function. Then there were cases of evergreening of loans. You give loan to one party before the due date, you give another loan so that the earlier loan is repaid, and a fresh loan is given. So effectively, it was evergreening. So again, that was having effect. So this resulted in a significant enhancement of clause 3, which we will see. Going concern, yes, we already discussed somewhat. Loans and advances to related parties. So related parties is a big area of concern where you can actually do fraudulent financial reporting, siphon of money. And if we look at the NAFRA findings, they have actually raised concern about one of the large audit firms audit regarding related party transactions. So related party transactions have come in focus. They have included related parties under various clauses in revised CARO 2020, as you will see. So given this background, the objective of introducing CARO 2020 was to bring in more transparency in financial statements of companies, enhance trust in financial reporting, because a lot of things will now be out in the CARO report. So as far as applicability is concerned, there is no change in the applicability of CARO 2020 as compared to CARO 2016. So all the companies where reporting under CARO 2016 was required, the same requirements would be applicable for reporting under CARO 2020. So this is applicable for the audits of financial year 21, 22 and onwards. So this is the first year of CARO reporting. So the applicability. So CARO 2020 is applicable to every company, including a foreign company. So when I say foreign company, your license offices, your branch offices, that would be covered. It is not applicable to a banking company, but it is applicable to non-banking financial companies and housing finance companies. Not applicable to insurance companies. Not applicable to companies licensed to operate under Section 8 of the Companies Act 2013, and the guidance note has clarified. Also, not applicable to companies operating under Section 25 of erstwhile Companies Act 1956. Not applicable to one-person company. Not applicable to small companies. Now, why I have highlighted small company, because when the CARO was initially released, the definition of small company was different. So at that point of time, the definition of small company included companies where paid up capital was less than 50 lakhs and turnover was less than 2 crores. Whereas now the criteria has been raised to 2 crores of paid up share capital and 20 crores of turnover. Now, how it is affecting? We look at the next exemption, which is private companies. whose gross receipts of revenue, including revenue from discontinuing operations, less than or equal to 10 crores in the financial year. So earlier, small companies had a turnover of less than 2 crores, but the exemption was to more private companies meeting all the criteria for exemption, where the turnover was up to 10 crores. So now, in view of the change in definition of small company, this particular exemption is as such redundant. So another exemption for private company was where the paid up share capital plus reserve is less than or equal to 1 crore as on the balance sheet date. So now small companies, are companies having a paid up capital up to 2 crores. So again, this part of private company is not relevant, which is not a holding or subsidiary of a public company. Now this particular clause is also applicable to small companies. So again, this particular clause is not relevant. So borrowings are less than or equal to 1 crore at any point during the financial year. So this might be applicable, but all the four conditions for private company exemption should be satisfied. So in most cases, where the exemption was given to on this particular clause would be, mostly exempt under the small company. And if a company is a small company, then you don't need to go to the next clause of private companies to check exemption. So if it is a small company, CARO reporting is not required.
Which means, sir, please.
Yeah, please.
So there are four lemns you said for private companies.
Yeah.
Gross receipts or revenue is less than or equal to 10 crores. Whereas if it is a small company, it is up to 20 crores is a small company.
Yes.
So no need to check this point if it is a small company.
Yeah, so if it is a small company, that it is not a holding or subsidiary company, it is not a public company, paid up capital up to 2 crores and turnover 20 crores, it's a small company, you don't need to go to the next clause to check exemption. It is by default exempt from CARO 2020. So basically, when the government came out with this order, it was in February 2020, and the small company definition was changed effective 1st April 2021. So the parallel amendment has not been into CARO order. So, but a revised guidance note that Institute is proposing to issue sometime in first week of July will clarify this point. It is already covered in the exposure draft that was issued about 2 weeks back.
Vishnu has asked the turnover whether it includes safety interest and income tax refund interest.
So it talks about turnover. Turnover means basically revenue from operations. So other income is not considered as turnover.
Right, sir.
So if we look at the CARO 2020, so there are 28 new clauses. I mean, the total number of clauses is 21. So if I count sub clauses, there are 28 new reporting requirements. 16 have been modified as compared to CARO 2016. 7 have been carried forward as it is from CARO 2016 with no modification, and one reporting requirement has been deleted, and the one which has been deleted relates to payment of managerial remuneration in accordance with Companies Act. So now this requirement is any case in the main audit report, where under section 197 you are required to comment whether remuneration paid and provided is as per Companies Act, including Schedule 5. So it
So
was a duplicate.
can you just repeat this, what you said just now regarding
So,
remuneration?
yeah, so in CARO 2016, there was a reporting requirement whether managerial remuneration is in accordance with the provisions of Section 197 of the Companies Act, read with Schedule 5. Now, there was also a parallel reporting requirement in the main audit report. So there was a duplicacy that was happening. So you were required to report in the main report also and in the CARO report also. So what they did was, while drafting CARO 2020, they deleted the requirement from CARO. So in the main audit report, you are still required to report on the compliance regarding managerial remuneration.
And it is not applicable to private companies.
So you have to mention that, because you cannot, delete that reporting. You say, company being a private limited company, provisions of section 197, read with schedule 5 are not applicable to the company.
And this we have to do it in main report now.
In the main report. It was there earlier also, but there was a duplicacy that was happening.
Yes. One question has come. Is it perfect to take questions simultaneously, or you want us to wait?
So I am okay with both.
Okay. The Purnima Maheshwari if it is a small company and borrowing exceeds, then CARO applicable? Yes.
No, if it is meeting the definition of small company, it is by default exempt from CARO. And let me, I think this CARO revised guidance note has clarified. It has not been finally released, but the exposure draft, that has been issued and considered by the auditing standard board. It specifically mentions that where a company is exempt under definition of small company from CARO, borrowings would not be actually relevant because that is covered for private limited companies. So if it is a small company, then you need not check the borrowing part, and then CARO will not be applicable.
Okay, there are two more questions. Mr.
Yeah.
Sampath has asked, there's no clarity on show cause notice come demand to be disclosed when the assessing officer yet to confirm the demand, as CARO 20 mentioned, that it has to be analysis on each case. It is suspended. That guidance note may clearly mention that auditor may not include till demand is confirmed. This is one.
Uh, So basically, show cause notice is not a demand, so you need not, report. I'm assuming you are referring to clause 7 where you have to report disputed demands, right? Clause 7B.
Okay.
So only confirmed demand which are disputed are reported under, clause 7B. So in any case, you will have to, for the purpose of the financial statement, you will need to assess from the perspective of accounting standard on contingent liabilities whether any disclosure is required or not. But so far as CARO reporting is concerned, unless it demand and disputed, it is not to be, reported.
Okay. Abhishek Chapolika has asked, private limited company which is subsidiary of foreign company and share capital is 1.5 crores, revenue is 15 crore, whether it will fall under small company?
Uh, Small company definition is basically it should not be a subsidiary or a holding company of a public company. So foreign company is a body corporate and not a company. So subsidiary of a foreign company can qualify to be a small company.
Okay, sir.
So CARO 2020 was released sometime in February 2020, and the guidance note on CARO was also released around July 2020. Subsequent to that, in March 2021, after a lot of persuasion by the institute and representations with the Ministry of Corporate Affairs, Schedule 3 was also amended to include certain requirements which are already there in CARO 2020. The main objective of the institute in following up with the MCA was that first the reporting should be from the management side, and then the auditor should be liable to report. So the earlier, the entire responsibility was falling upon the auditors, whereas there was no responsibility on the management to report certain things. So I would still, because I understand we have already had a session on Schedule 3 last week.
Yes.
So I will just quickly, read the clauses of CARO which have a parallel reporting requirement in Schedule 3 and certain differences. So title deeds of removal properties, it is there in CARO as well as Schedule 3. There are similar disclosures in both places, so no such major change. So then revaluation of property, plant and equipment, again parallel reporting requirements in CARO and Schedule 3. Uh, Benami property transactions proceedings, again same reporting requirements in CARO 2020 and 2000 Schedule 3 2013. Next is the working capital limits. So the CARO reporting is sanctioned working capital limits in excess of 5 crores. However, Schedule 3 does not have any limit. It requires all borrowings to be considered for the purpose of Schedule 3. So reporting under CARO is slightly less onerous than the reporting under Schedule 3.
So if it is a small company,
Yeah.
CARO will not be applicable, but Schedule 3, there's a requirement to report on working capital, so
Yes.
we have to do it.
Yes, yes. So Schedule 3 does not talk only of working capital, it talks of all loans. So, all loans you have to disclose whether stock statements are in accordance with the books of accounts or not. So that is a very important point that
the
you
only
raised.
only point here would be that it is the management's responsibility to report there, not the auditors. But auditor has to check it.
Yes, so you're right. It is a management responsibility, but if from the course of auditing, the auditor finds that this is not correct, then nothing stops the auditor from reporting in his main report. That option is always available, provided to ensure that the financial statement not materially misstated or misleading. So that
So
option.
will be discussing these points in detail later, or
Yeah. So I will be discussing the requirements of CARO later, just to give a snapshot of the parallel
right, right,
requirement.
right.
Right. Right. So the next clause was related to company has granted loans or advances in the nature of loans, either repayable on demand. This is particularly clause 3F. So there is similar reporting requirement for schedule 3. Now, unrecorded transactions which have been surrendered or disclosed as income in the tax statements. If so, whether the previously unrecorded income has been properly recorded in the books of accounts. So now there is a slight difference in the CARO reporting and reporting under Schedule 3. Now, Schedule 3 specifically mentions that if there is an immunity from disclosure, then the company may not disclose. However, CARO has not mentioned any such thing. So the guidance note being revised will try to address this issue. So they are trying to align the reporting requirement under the Schedule 3 and CARO. So that has been discussed at the Auditing Standard Board day before yesterday, and hopefully there will be a clearer guidance on this aspect.
And what is the timeline for new guidance note to come?
So I think it is being taken up at the council meeting being held next week, just before the CA day. So I think maybe shortly after CA day on 1st July, the revised guidance note should be out.
Okay, right.
Yeah. So again, declaration of willful defaulter of the company. Again, their parallel reporting requirements, no change. Uh, Whether term loans were applied for the purpose for which the loan was obtained. If not, the amount of loans were diverted and the purpose for which it is used may be reported. Again, broadly similar requirements, except that the CARO reporting is restricted to term loans, whereas Schedule 3 talks about all borrowing. So even cash credit or any other loan which is not a term loan, if it has not been used for the specific purpose, it has to be reported by the company. Uh, then material uncertainty relating to financial ratios, based on the financial ratios. So the reporting and the CARO is much wider, whereas under Schedule 3 you have to disclose only certain ratios which may give you an idea about the solvency position, but the reporting under CARO is much more extensive than the disclosure required by the company. Uh, then CSR, more or less similar requirement, except that disclosure in the Schedule 3 are slightly more detailed. The auditor just has to report on the compliances with Section 135, subsection 5 and 6, whereas the company is required to give full details about the amount required to be spent, shortfall, total of previous year's shortfall, and reason for shortfall and nature of sales activity. So these are 10 clauses which have a common linkage between CARO reporting and disclosure in the Schedule 3. So we'll come to the clauses of CARO 2020. So I will first try to cover the clauses which have significant, changes from earlier version. So first we have the property, plant and equipment. So subclause 1A, which says whether the company is maintaining proper record showing full particulars, including quantitative details and situation of property, plant and equipment. So one change is nomenclature. It is now property, plant and equipment aligned with the changes in accounting standards. Earlier it was fixed assets. There is as such no change in reporting requirements. And now, where the company is following Ind AS, right of use assets, which are covered by Ind AS 116, also requires reporting. So you have to maintain proper records for right of use assets also. Subclause B says whether these property, plant, and equipment have been physically verified by the management at reasonable intervals, whether any material discrepancies were noticed on such verifications, and if so, whether the same has been properly dealt with in the books of account. Again, there is no change in requirement except the right of use assets also need to be physically verified. Uh, what constitutes reasonable interval would depend on the circumstances of each case. So guidance note has also, given various scenarios, but talks about generally a period of 3 years where all the fixed assets should be covered. So while auditing, you should obtain the policy for physical verification. So there could be multiple, combinations. One is assets are physically verified every year. One is assets are verified over a period of 3 years. So uh, uh, so you verify some assets in first year, some assets in second year, and balance assets in third year. And another option could be verified once in 3 years or once in 2 years. So depending on the policy, your reporting would be affected. Guidance note says it should be verified at least once in every 3 years. So program of physical verification cannot exceed a period of 3 years. Intangible assets. So the requirement is whether the company is maintaining proper records showing full particulars of intangible assets. So if you ask me, as such, there is no change from the previous version. If we refer the guidance note in CARO 2016, where they have defined fixed assets, they have included intangible assets, but it was not clear in the CARO reporting. So now the government has actually introduced a specific reporting requirement for maintaining proper records for intangible assets. So consideration should be made to the principles, accounting aspects and disclosure requirement in India's 38 for India's companies and AS 26 intangible assets for non-India's company. So intangible assets can be customer-based intangible assets, marketing-based intangible assets, contract-based intangible assets. So there are various categories of intangible assets. So the particulars that are required to be maintained in the register should include quantitative details. So, for example, if you have SAP licenses, so how many licenses you obtained, situation where the licenses are in the which machine numbers, original cost, register of amortization, which is over the period on which the intangible is being amortized, subsequent expenditure, if any, registration records. So if you have trademarks, so these need to be registered. So you have to mention the particulars of those which refers to registration records, license registered, etc. of intangible assets. So auditors should consider whether the intangible is self-generated and they are properly classified, or they are acquired intangibles and they have been properly classified as such. So I think some people have raised hands. Like you can take the questions.
Okay. So members, if you really want to ask some question in person, please let us know. Or shall I just, okay, let me allow you to participate in. Sanjeev ji, you are allowed to talk. Please raise your query if you have. I don't think he has a query. Sanjeev ji, you want to speak? No. Raj sir, you are allowed now to speak. Okay, Dinesh Kalra.
हेलो
हाँ जी दिनेश जी, you have a question?
नहीं अभी फिलहाल तो नहीं है, मैं लिख दूंगा.
Okay. राज जी अनम्यूट करें अगर आपको कुछ नहीं पूछना तो.
अच्छा अच्छा ठीक है.
अभिषेक.
Hi Pranav.
Hi, Raj.
Pranav, just have a small question. I have raised the questions wherein I have put an example. If a company is a subsidiary of foreign company with a turnover of 15 crore and let's say share capital of 1.5 crore, so whether CARO is mandatory. So you have explained it's falling into the definition of a small company, so we may exclude it. So
Yeah.
I'm just reading section 285. A small company means a company other than a public company, then two clauses, 2 crore and 20 crore limit. After that, provided that nothing in this clause shall apply to a holding company and a subsidiary company. So
Yeah. So when we talk about holding and subsidiary company, it talks about holding and subsidiary of Indian company. Foreign company is a body corporate. So the small company does not, so it is not. If it's a subsidiary or subsidiary of a body corporate, it is exempt actually.
okay. So after that, it's a silent. They have not written that holding and subsidiary of Indian company That's why I have the confusion.
Yeah. So basically, they are looking from the perspective of Indian companies. So I can send you a clarification on this separately. But since it's a foreign company, because we have encountered certain cases and we have taken a view based on the interpretations of Ramaiya and all that, that subsidiary of a body corporate is exempt, because otherwise, this section would have no meaning. There are a lot of foreign companies which are having their subsidiaries in India actually.
Mhm. Okay, so we can consider it falling under.
Yeah. We can consider it.
Okay, thank you.
Thank you, Abhishek. Please, sir.
Yeah.
And one more, Vishnu Guhaji is asking, director salary paid.
As far as CARO is concerned, if you are paying salary late, there is no concern. And even in the companies that I think there is no issue, that's a contractual obligation in the director of the company to pay managerial remuneration. So as such, there is no reporting requirement.
Sorry, sir, I got a call.
Yeah, no problem. So what I'm saying is director salary, even if it is paid late, so there is no reporting requirement in CARO or main audit report or even elsewhere. So it is
Yeah.
basically a contractual obligation between the company and the director. So so what the government is concerned with, that the remuneration paid should be in accordance with the provisions of law. And if you're paying late, if there's TDS to be deducted, that you should ensure compliance with. The TDS is deducted and deposited in time. Otherwise, there would be impact on your tax audit. And also, if there's delay in deposit of TDS, CARO clause 7 might be triggered only to the extent of delay in deposit of TDS without any connection with the managerial remuneration. Just like any other TDS on salaries, also if you're depositing late, reporting would be there. So as such, director salary has no linkage with CARO.
Maybe he's asking because there are certain labor laws which want employer to pay salary by a particular date of a month.
So that is under labor law. But the guidance note is not considering labor laws unless it's a statutory due. So statutory dues would be professional tax or labor welfare fund or provident fund, ESI. It is not considering salaries and wages under definition of statutory dues.
Labor welfare fund you've spoken just now.
Yeah, labor welfare fund is a government statutory due, because that you have to deposit to the government.
Yeah, but is it applicable to? I mean, is it state specific?
Yeah, it is state specific. State specific.
In Delhi, is there any requirement?
No, I don't think there is any requirement in Delhi for labor welfare fund.
No
Haryana
requirement.
has. Haryana has. Punjab has.
So in Delhi, there is no requirement.
No requirement.
Okay.
But if the company is operating in various states, you have to be ensuring that whichever state labor welfare fund is applicable, it is deposited in time.
Okay.
And each state has a different, due date. Some are on a half yearly basis, some on an annual basis, some on a monthly basis.
Okay. So if it is not in Delhi, we have to report it main report, and we all are reporting that it is not applicable. Maybe what the question is, company in rental office, any issue? Vishnuji, please elaborate your question. Which particular, I mean, what exactly you want to ask? Please, sir, Pranavji.
Yeah. So I think once he clarifies, I will take up this question.
Yes, sir.
Right. So the next clause is 1C, which relates to title deeds of immovable property. So as such, there is no change in the reporting requirement as compared to previous version, except more details are required. So if we see earlier, it was just mentioning whether the description of the property, gross carrying value, and period held. Now it requires to specifically mention whose name it is held in, and whether this person is a promoter, director, or the relative or employee of the company, and also give the reason for not being held in the name of the company. So it has enhanced the reporting requirements, probably because there were certain cases where company was capitalizing property, but it was actually belonging to the promoter or shareholder. or some directors. So to bring out the clarity that they have asked specific reporting in this regard.
I remember one case wherein when asked the directors to show me the property papers,
Yeah.
so that I can report here, he said we have already informed you that it is in the name of company, and when I insisted, I was asked to resign.
Okay. Yeah, that is a problem. And one more thing that I think one must take care of is, certain cases the company has pledged the property for loans, and the
Yeah.
original title deeds are with the banks.
Yes.
So in this case, what you should do is you should probably ask for confirmation of the banks whether the title deeds of such properties are with you, and banks have been responding, and you should in any case verify the photocopies and obtain confirmation from the banks, and obviously you can always verify the charge document whether this particular property has been charged. So this will give you evidence, yes, because banks will not take a property without the documents being proper. So verification of charge will also give some comfort. In any case, confirmation is most desirable if available. So these are the procedures the auditor needs to perform.
Sir, ROC charge, MCA charge, you've just spoken. In most of the cases where the properties are not in the name of company, no ROC charge is registered.
Right. So now, very interesting point you have raised, Vijay, where the company is showing that property is in the name of the company, so it's appearing in the property, plant, and equipment, and they say they have taken a borrowing against that particular property, and the title deeds are not available, and charge is also not registered. One, obviously, reporting under this clause will be triggered. Next, very important thing is the charge is not registered. Company has to, also make a disclosure in the financial statements. The charge has not been created. Now, assuming that company is not in the name of the property, the charge cannot be created. So, in such cases, the loan has to be considered as unsecured loan. It cannot be shown as a secured loan. That is very clearly mentioned in the guidance note to Schedule 3, which says unless the charge is on the asset of the company which is taking loan, it cannot be shown as a secured loan.
If the property against which the loan, whether it is a primary or a collateral security, if it does not belong to company, means titles are not with the company, with the directors.
Yeah.
Then in that case, now charges are not being registered.
Yeah.
Whether it would be still be showing as secured or unsecured.
Unsecured, sir. Very clear. Guidance note on Schedule 3 clearly mentions this.
Okay. If it is a primary security being the property.
Yeah, primary security. See, banks are more concerned about their money. So,
Yeah.
if the promoter shareholder also pledges his property as a primary security, right, they will give you the loan, right? But since that property does not belong to the company, the loan cannot be considered as a secured loan. It has to, disclosure would be there that the security is of the property of the promoter director, but it will have to be classified as unsecured, even if the value of the security is much more than the loan.
And in a scenario where MCA charge is registered against the property of the directors also, then what will be the scenario?
See, I don't think personal property or director charge can be directly created. Let me check with that. But again, since the property is not of the company, it is still an unsecured loan.
If the property is not of the company, whether or not charge is created,
Yeah.
whether ROC
Give
it
me
would be.
give me a minute. Let me just open the guidance note on Schedule 3, which clearly mentions this. Just
Yeah,
give me.
please. And meanwhile, I'll again. At times there are stocks and debtors. So in that case, it belongs to company. It would be a secured.
Yeah, it would be a security. That would be a
Secured borrowings.
security.
If it is only purely property, what you
Yeah,
are saying is if it belongs to the company, titles are of the company, then it will be secured, otherwise unsecured, which
yeah,
you are
yeah.
checking and
Absolutely,
informing right now.
absolutely, sir.
Yeah, please.
One second. Just give me 1 minute, sir. Just open it. Just 1 minute, sir. I'm just opening it.
Yes, sir. So there's a message from Sanjeev Jain who says charge will be creative irrespective of primary or not, means whether it's a collateral security or primary security, and also if the security pertains to persons other than the company, charge will be created. The idea is whether loan is secured or not.
Yeah. So
And you can clarify later also. No issues.
right. So I've just found this paragraph.
Yeah.
Uh,
Thank you, Sanjeev ji, for the.
The charge will be created, that is fine, but the it will not be treated as security, secured loan. I'll just share the particular question. So is the screen visible?
Yes, yes.
Right. So paragraph 8.3.1.14. When promoters or other shareholders or any third party have given any personal security for any borrowing, such as shares or other assets held by them, disclosure should be made thereof, though such security does not result in the classification of such borrowing as secured.
Okay, but it does not speak. Other assets will cover the property also.
Yeah. Or any asset.
Okay, Amit Kapoor has also said it will be unsecured loan as no security was given by the company.
Welcome.
Yeah. Okay, so security is in respect of the security given by the company or not.
By the company or not. Charge would be created, yes, because even when the even when the group company gives a holding company gives a security for a loan taken by subsidiary, charge would be created. Yes, I agree in that, but subsidiary would have to show it as unsecured loan because it is not the property of the subsidiary company; it is the property of the holding company.
Right, got it.
And there would be, obviously disclosure in related party transactions in such cases. So then the new reporting.
Again, it is coming. I mean, so is it that it is unsecured in respect of the company borrowings,
Yes.
although it is a secured one?
Right.
Okay.
It is secured from the bank perspective, but from the financial statements perspective of the borrower company, it is unsecured.
So we've been I mean, at least me, been showing always as a secured borrowing.
You have to change. You'll have to change them.
Yes, sir. Thank you.
Right. So next requirement is a revaluation of property, plant and equipment intangible. This is a new reporting requirement. So where although accounting standard permit both cost model and revaluation model. So where there has been a revaluation and the revaluation is more than 10%, more than 10%, then the it could be either upward or downward. It has to be reported. Specify the amount of changes if changes 10% or more, and of the net carrying amount of each class of property, plant and equipment or intangible. So when we talk about each class of property, plant and equipment, so land would be a separate class, machinery would be a separate class, vehicles would be another class. So it cannot be said ki, there has been revelation of all the classes and the in totality it is less than 10%. So not to be reported, no, it has to be done class wise. So if land is there, building is there, so each will be considered separately and not as a net wealth. Benami property, again, there is a corresponding requirement in Schedule 3 also. So it says whether any proceeding has been initiated or are pending against the company for holding any Benami property as defined in the Benami Transactions Prohibition Act 1988 and rules made thereunder. If so, whether the company has appropriately disclosed the details in its financial statements. So it's a new reporting requirement. So proceeding can be initiated by the initiating officer and or proceeding being pending against the company before initiating officer or adjudicating authority or appellate tribunal, high court, supreme court during the preceding financial years. So reporting is whether the such property have been appropriately disclosed in the financial statements. So there has to be adequate disclosure in the financial statements, which means nature of the property, carrying value of the property, status of proceeding before the relevant authority, and liabilities. Uh, so if you see, when the CARO 2020 came, it required, the auditor to comment whether the company has appropriately disclosed the details in the financial statements. So it was required by the company to disclose the financial statements even without the amendment to Schedule 3. Schedule 3, because if the company had not disclosed, the auditor would have, in such cases, given an adverse mark that the company has not disclosed, although their transactions proceeded in the Benami Property Transaction Act. So, Schedule 3 only clarified, even if they had not clarified, as a reporting requirement under CARO, this was already would have been applicable to the company. So reference should be made to the Benami Property Transaction Act 1988 and its rules, reporting limited to adequate disclosure in the financial statement and to cases where proceedings are initiated with the company being treated as Benamidar. So the auditor, as audit procedure, should make necessary inquiries from the management in respect to such properties, including obtaining a management representation letter.
Sir, coming back to secured portion.
Yeah.
This
yes,
is regarding MCA, I mean the companies. What about non-corporate assets? If it is if the security is given of not of the firm, naturally of the proprietor, maybe in case of proprietorship of the proprietor, but in case of partnership, one of the partners. So what would be the scenario? Will it be secured or unsecured?
So I will tell you a practical case that we recently encountered. In case of proprietorship, where the proprietor has given, so we have considered to be a secured, because proprietor may have multiple businesses, but ultimately he's the same person. Uh, so in proprietor case, even if the proprietor has given, so we have considered for that particular business is a secured loan. But partnership is a separate legal entity, right? There are a number of partners. So in partnership, again, we had a similar case very recently. So we said we'll have to apply the same principles as of Companies Act, because there is no contradictory view for non-corporate entities, right? So the guidance which has been given in Schedule 3 guidance note by institute should apply, in all such cases. So LLPs or partnership firms, being separate legal entities, independent, so they are assessed also as partnership firms, whereas proprietor is assessed in income tax, as an individual. All his businesses are assessed together. But in partnership, they are assessed independently of the partner. So the same principle would apply. So where one of the partner has given security, then for the partnership it is unsecured loan.
Right, sir. Thank you.
And a very simple reason is because the bank cannot proceed against the partnership firm. They will proceed, to recover the property from the partner. So, as such, the partnership So one can always say if a partner has given, so you take the recovery from the partner because it is his property.
Okay.
So physical verification inventory, so it has enhanced the scope of reporting. Earlier, it was restricted to whether physical verification is adequate and material discrepancies have been appropriately adjusted. Now it has specified that whether any discrepancies of 10% or more in the aggregate for each class of inventory were noticed, and if so, whether they have been properly dealt with in the books of account. So they have given a threshold if there is a discrepancy between physical stock and the book stock of more than 10% for each class. Now again, when I say each class, stores and space is a separate class, raw material is a separate class, work in progress is a separate class, finished goods is a separate class, traded goods again is a separate class. So for each, you will have to assess individually whether the deficiencies in book stock and physical stock is 10% or more. Then you have to specifically mention that.
So whether at times we would see if you really ask the companies or the directors whether they've physically verified the inventory, they would say yes. However, they may not be able to show the records. What would
Right.
be our as an auditor the responsibility and what should
Right, right. So there are two parts to it. One, if we go to Standard Auditing 501, so which is special considerations regarding audit evidence. So they have specifically mentioned that the auditor should participate in the physical verification of inventory. So it is a mandatory requirement for the auditor to participate in physical verification. How many locations or what is the extent of coverage, that would be a professional judgment, but it is a procedure that auditor has to mandatorily follow. Now coming to the specific question that you have asked, so guidance note on CARO gives various and even SA 501 if we talk about it. So they have said what should be the procedures, what should be the internal guidelines, what should be the there should be a documented process for physical verification of inventory. So guidelines, who will verify, when will they verify, what will be the procedure in case of disturbances, who will authorize, who will supervise. So there has to be detailed guidelines. So if that documentation is not there, you cannot conclude that physical verification was conducted, because you have to again report procedure of such verification by the management is appropriate. So in the absence of documentation and stock sheets, verification remarks, signing by 2-3 persons, who are physically verifying, and also the supervisor, how can an auditor conclude with the verification is appropriate? So that is very important actually to ensure.
and now you said that it is the auditor should be part of the physical verification. Now, question is whether that's physical verification where the auditor should be a part of
Yeah.
would be at the year-end verification or anywhere in the during the year.
So
At least
again,
once or at least once during the year.
yes. So actually, if you ask me, it should be as close to the year end as possible, because if we see SA 501, what it says that if it is not at the balance sheet date, then you have to do roll forward, roll back procedures. So if I have done the physical verification, let's say on 15th of March, right? So I will have to do a roll forward to 31st March. That is, I will have to make adjustments for sales and purchases during the period of my physical verification up to the balance sheet date. Now, as the difference between the balance sheet date and the date of physical verification grows wider, this exercise becomes very cumbersome.
Okay, that's true. But for how many companies the auditor can be there? I mean, the staff of the auditor can be there on closer to the financial year.
It's a very challenging aspect of the practice. I understand. So you can do an assessment. Which are critical companies where physical evacuation around 30, 31st or first is more critical, and depending on the volume, maybe some companies you can do that around 25th or 26th, or even 5th or 6th of April, and then do a rollback, roll forward. Or if you consider the inventory is totally immaterial, maybe anytime during the year you can do a process check, and document the reasons for not doing at the year end and ask the management to do a year end verification.
And where mostly, or if not mostly, where the auditor were not present during were not part of the physical verification, then what would be the challenge for the auditor?
See, now what is happening is with the increased, this scrutiny of the auditor's work by the regulator, and inventory being a very critical item because it's very prone to manipulation, either in terms of quantities or valuation, damaged or obsolete stock being shown as good. So, where NAFRA or other regulators are doing their reviews, even the peer review by the institute, they are asking for physical verification of work papers. So, so that could be a challenge at a time of a regulatory review. So, if you are outside the NAFRA review, then probably the only review could be peer review by the institute or a random pickup by QRB. But as a safeguard, physical verification procedure should be done.
And another related query, sir. I'm sorry, I'm asking so
No,
much.
no, 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 please, so please.
If you look at the balance sheets, financials, and mostly private companies where your audit fees is it ranges between 50,000 to 1 lakh rupee, and inventories are huge, and you're not actually participating in the physical verification. What to talk of year end? Nowhere, never in the during the financial year also. And if you want to really would like to be there, then what the cost involved would be so heavy. What to do?
So now there are multiple answers that I would like to address. One, if the fees
I
is
mean, these
low,
are related
I,
queries I'm asking.
I agree, sir, I agree. So now if before a regulator, as an auditor cannot justify low fees for not adhering to standard procedures, because if you look at standard auditing, inventory verification is a mandatory procedure as per SA 501. So, regulator would say that we should not have accepted the assignment at a low fees. But a low fees cannot be a reason for non-compliance. So
Yeah.
that is a, legal point of view. Now coming to a larger point of view, I think why we chartered accountants are quoting such low fees because the responsibilities are increasing. So compliances with various standards on auditing, guidance notes. Now, if you see last 2 years itself, Schedule 3, CARO, and now audit trail is also coming effective 1st April 2023. Right. So that again would be a challenging task, to audit the audit trail. Now, so many things happening. So we chartered accountants are responsible for this entire mess of taking audits at a very low fee. So I came across a company which was having a manufacturing plant, two manufacturing plants, turnover of around 2,000, 3,000 crores, and the fees were 2 lakhs. I mean, like that's not practically possible to do an audit of 2,000 crore turnover company with two locations, two manufacturing plants, uh, in 2 lakh rupees. So, but the auditor was doing.
No, true. But another set of questions are, say the fees is 1 lakh and turnover is 100 crores of a trading company. The private limited company is only into trading of some goods.
Yeah.
And if you really ask, so I'm not asking the fee increase. If you really ask the directors that whenever you are taking inventory, please inform. I'll be part of it, and they won't agree. What is to be done?
So then it is a scope limitation if you ask me. So SA 705 allows you to give a disclaimer on inventories. So unless and until the auditors stand up against the management for not allowing them to perform certain procedures, the quality of audit will not improve. That is for sure, sir. That is a challenge, and the regulators will not listen to it. They would give the same answers I've given, that what stopped you from qualifying your report or giving a adverse opinion or a disclaimer under SA 705.
Okay. Now again, so March 22 has already gone,
Yeah.
and there may be so many CAs who have not participated in the physical verification whenever done by the companies. Now, can they qualify the report, and if yes, how? We may be going out of this topic today, but these questions are very relevant.
Sir, frankly, I really don't have any right answer to this question. Maybe, you could do a verification now and, prepare some sort of a reconciliation in the year end till date. See, this is what has happened. Uh, the moment purchase sale, if that is possible. So, but I think documentation should be in any case, I'm not sure if the management has also done physical verification or not. But that again
Yeah,
would be a challenge.
yeah.
So
But
that is a
can we add some line of reporting in our main report? Is it to be reported in my main report or wherever we have to?
so it is required in CARO reporting only, sir. So I mean, like that whether verification has been done, and see, as far as you are concerned, that whether you have done or not is not to be reported anywhere, right?
Okay,
We just have to report in CARO on the management process. That is one part. So, but from a regulatory perspective, whenever there is a review, quality review by any regulator, they would ensure compliance with SA 501 where you are mandatorily required. So it
okay,
may not affect your report directly, but in case of a technical review, it would definitely have an impact.
okay. So at least for now, what we can safely say that maybe until this year we have not done so. We've not been part of the physical verification team whenever it was done by the client.
Yeah.
Make sure that this year, financial year 22-23, we are part of the physical verification of this inventory.
Right. So I've got a very interesting comment. I think Mr. Sivaraman Vishwanath has written. Basically, auditors are no more watchdog or
Yeah.
bloodhound and approach the audit with the intention that all companies are bent upon cheating the government. So, see, the problem is that there were standards in auditing always there for last at least 15, mandatory in the current form. They are applicable mostly, I think, from 2008 or 9. Right. So the problem is the auditors have not been following auditing standards. Had the auditors been following auditing standard and ensuring adequate disclosures as per Schedule 6 earlier and now Schedule 3, the situation would not have arisen. So basically, chartered accountants have themselves lost the faith of the government, trust of the government. So that is why it is appearing now that we are expected to be bloodhounds. Nothing is beyond the auditing standards. Government is not asking you to do anything beyond auditing standards. But we unfortunately we have not been following the auditing standards. So this pressure has suddenly built up with so many, because see, if you see Schedule 3 changes also now, there is an enhanced reporting disclosure requirements for capital work in progress, which is not completed within time and their cost have exceeded or timeline has exceeded. Now, as an auditor, you were always supposed to verify whether the capital work in progress is progressing as per the time schedule. Otherwise, impairment provisions would trigger it. Now, see, the rationale for that clause is that banks were funding projects, projects, right? So there's a reporting whether term loans are used for the purposes of which are taken. So you do a token work, start a capital progress, and then use the money for other purposes, right? So as an auditor, you are supposed to do it, but since you are not reporting and the banks are losing money, so they said, okay, why not ask the auditor to specifically comment on this, or in the Schedule 3. And if there is a deviation and the auditor has not reported for mispresentation by the management in Schedule 3, we now hold the auditor responsible. So, they similarly for debtors aging, now they have asked you to report aging wise, disputed, undisputed, disputed considered good, disputed considered bad. Now, a debtor outstanding for more than 3 years considered disputed and considered good. Why there should not be a provision? It is more than 3 years, it is disputed, and still you have considered good and not recorded any provision. So this was always supposed to be done, but was not being done. So they said, okay, let's put either in CARO or Schedule 3, and Schedule 3, auditor has a responsibility to report. If they fail to report on the adequacy or disclosure or appropriateness, we will hold them responsible. So that is the background. Problem is that actually.
Okay, got it, sir.
Okay, so next. Now, next important clause, whether during any point of time of the year the company has been sanctioned working capital limits in excess of 5 crores in aggregate from bank or financial institution on the basis of security of current assets, whether the quarterly returns or statements filed by the company with such banks or financial institutions are in agreement with the books of account of the company. Now, the point is it talks about sanction limits. Whether you utilize or not, that is not relevant. So if you have a sanctioned limit of 5 crores or more any point of during the year, so even if at one day you have a sanction limit of 5 crores or more, this clause is triggered. Okay, amount actually utilized is not relevant, right? So you have to verify the stock statement, debtor filed on a quarterly basis. So the banks maybe asking for monthly statement, but the reporting is for quarterly statements. So you should restrict yourself to quarterly returns that are being filed, right? Current assets are to be considered as defined in Schedule 3, right? And the limit would be aggregate of working capital limit to all banks and financial institutions. So maybe have one bank 2 crore, another bank 2 crore, and a financial institution 1 crore. So in combination becomes 5 crore. It is not talking about any single bank or a single financial institution. It is talking about aggregate from bank or financial institutions. So you'll have to consider sanctioned working capital for all your banks and financial institutions. Right. The auditor should, not audit the quarterly statement. What they should do is, see the amount that has been reflected in the quarterly statement and compare it with the books of account. And if they do not agree, you have to report, right? Now the question would arise in case of non-listed companies, quarterly accounts are not prepared. In case of listed companies, obviously, for SEBI requirements, quarterly accounts are prepared, so it may be much more easier. So you'll have to give by the book balances. So whatever the balances are stated in the books of account, maybe Tally or SAP, whatever software they are using. Now, the practical problem, probably, the accounting entries are not done on a regular basis. Now, again, that would, trigger your reporting under internal financial controls, and also, maybe you have to consider the impact on your audit, because now, effective 1st April 2023, the new provisions regarding audit trail is also coming in, which would mean that any backdate entries or deletion of entries or overwriting the entries would need to be examined by the auditor and reported. So we have to start instilling a culture in the corporates that yes, we have to maintain your books of account throughout the year and on real time basis, and not at the year end when the audit begins you start putting all the entries. So coming back, so maybe if the quarterly books are not available, you will have to report the facts and qualify the audit report on the CARO book.
Now, same query. As you rightly said, books are not maintained on a day-to-day basis. Maybe they are maintained on a day-to-day basis, but at times bank entries are not being done on a daily basis, maybe once in a month or slightly delayed, because there are so many other compliances. Say for example GST compliance, one is to file GST return by 10th of next month or 20th
Right.
of next month is to be paid. So the thrust is to enter all the purchases, all the sales, all those expenses where ITC is available. So they are recording those on a priority basis so that GST return is filed, and later bank is updated. Maybe there's a 1 month or 2 months time lag for entering the bank. Then of course quarterly or monthly statements are to be submitted to the bank by 7th or by 10th of the month. So
Yeah.
those are given or submitted to the bank based on whatever data has been punched as on that particular date. and it will definitely be differing from if we today go and verify the quarterly data, because entries of the banks would be entered on the date of transaction itself, not on the date of entering into the software.
Right.
Whereas when it was the statements were prepared, certain entries were not punched, and when you are checking, all those entries were punched. Of course, the backdated entries were are there, so they will differ. So now, if we are to report whether those maybe, I mean, in this particular case, it is only debtors and creditors. I'm not taking stock as of now. What the auditor need to report here in this clause?
Okay, so we must understand the background of introducing this clause basically. So the background is, the stock statements and debtor statements were being overstated to increase the drawing power. So to restrict this, they said, let us hold the auditor responsible that, you check whether the statement being filed are in agreement with the books of accounts. Now, if the books of account are not updated, who will be held responsible if some fraud happens and the investigating agencies, conclude that the entries in stock were all backdated and the stock statement were actually not correct that were filed, and the company enhanced withdrew much more what they were eligible for based on the drawing power. So who will be held responsible? It will be the auditor who will be held responsible, because they will say, okay, company has done what, but you had a specific reporting requirement. So what were you doing? Why did you not report that the books of account were not updated? So you cannot comment.
Okay.
That is one part. And number two, as I mentioned, 1 year down the line, you have to maintain an audit trail, right? So if you are doing backdated entries, which the government does not want you to do, again, the auditor in March 24, when they issue the audit report, there's an additional reporting requirement, and that you have to verify the audit trail and report accordingly. Right. So if the backdated entries are happening, so what would you report? Obviously, the audit trail would reflect that. So you'll have to again report that yes, the company has been doing backdated entry. So I can understand the situation. Maybe one or two entries got skipped because the goods in transit were there, or stock came and quality check was not done. But that can be weak inside. But there cannot be a huge gap actually.
Okay, got it. And
And I think,
regarding
sorry.
inventories, they need to be tallied with the stock records maintained.
Yes, yes.
And if either stock records are not there or stock records are not proper, or then how to tally and what to report?
Right. So again, you will have to give a negative report that the stock records are not available, and then in the main report, whether you have to report whether the books of account are properly maintained. Right. So stock records are a part of books of accounts. So again, they will have to qualify.
And if the stocks are maintained on the tally or whatever SAP, whatever is software is used, if they are on tally or the software, whatever, then that is sufficient.
Yeah.
To check.
So if the stock as per tally or SAP agrees with the statement filed with the bank, that is okay.
That's okay.
That's okay.
However, those stock records are, I mean, they do have limitations. Not every stock is entered there. Only the major stocks.
So then there will be external records also available. No? So you'll have to generate a report from Tally or SAP and also the other external records that are being maintained, uh, and then comment on the statement.
Okay.
So there is one question in most of the cases, not on the last date of the quarter. So I am presuming the stock statements are submitted around 25th or 26th, whereas the quarter end is 30th, right? This is, I presume, is the question of Mr. Prakash Gupta. So here, thing is, yes, the reason why stock statements are being filed on 25th, 26th again is very obvious, right? So if the statement is filed on 25th and, let's say listed company quarterly accounts are maintained on 30th June, let's say, and the stock statement was filed on 25th of June. So nothing stops the auditor from verifying the transaction between 25th and 30th, and to ensure that that there is no significant abnormal entry that has been passed. So that reconciliation can be done if see their sale purchases are there, then and the stock is materially different from 25th and 30th, then that is okay. If it is reconciled and supported with documents, so that procedure still have to be performed.
Right, sir.
Right. Okay. This particular clause is a significant increase from the previous version of CARO. Just one second. Just one second. Yeah. Sure. Okay. So this sub clause, paragraph 3 has got 6 sub clauses. So if we recall, the earlier version, it was limited to very 2 or 3 sub clauses and limited to parties registered on section 189. Now, what has happened is they have enhanced the reporting requirements significantly. So let me read first clause 3. Whether during the year the company has made investments in, provided any guarantee or security, or granted any loans or advances in the nature of loan, secured or unsecured, to companies, firms, limited liability partnership, or any other parties. So they have significantly enhanced the scope. If so, now A, whether during the year the company has provided loans or provided advances in the nature of loan or stood guarantee or provided security to any other entity. This particular clause is not applicable to companies where principal business is to give loans such as NBFC. So if so, disclose the aggregate amount of loan during the year and the balance outstanding at the balance sheet date with respect to such loans, advances, and guarantees or securities to subsidiaries, joint venture, and associates, and in the next part to other parties. So basically, they have split the reporting requirement into 2 parts: one subsidiary, joint ventures, and associates, and the other part is to other associates, other parties. Now, a new concept which has been introduced is advances in the nature of loans. So, as such, this term has not been defined anywhere, but there is some guidance available in the guidance note on CARO 2020. So, let me give an example. So, you are purchasing some material from a group company, and your normal purchases are, let's say, uh, 10 lakh rupees a month, right? And the credit terms are 60 days. Now, you have given an advance to such party of, let's say, 2 crores, right? So which is in and you are saying it is an advanced supplier. Now the auditor needs to assess that what is the amount of purchases that I am making from this particular supplier, and whether this amount is reasonable. I mean, like if purchasing 10 lakhs a month and I've given 15 lakh rupees of advance, it is more or less in the nature of advance. But if I've given advance of 2 crore rupees, whereas my annual purchase itself is around 1 crore, so it cannot be said to be in the nature of advance. So it becomes assumes the character of loan per se. So that is what the guidance would explains, that it is in the nature of loan basically. So even
So, but
yeah, yes,
we
sir.
have to verify this kind of advances in the nature of loans for every supplier, or to the related parties mainly.
See, this would normally happen for related parties, right? But advance to supplier as a part of your audit procedure would be verifying, right? So, depending on the materiality, you will not obviously look for very small amounts. So only where amounts are very substantial, you can have a look what is the amount of purchases or credit terms, or whether there is a valid agreement. Suppose I am importing a machinery, right? And a substantial amount is there, 1 crores, and it requires a 50% advance, and the delivery will happen after 6 months. So all these terms are mentioned in a purchase order, right? So then I can conclude, yes, 50 lakhs will be settled after 6 months only, and it is as per PO terms. So I cannot say it is a loan; it is a advance. So, but So you have to assess on a case to case basis. So you will not obviously be going into every small amount. So you can take a threshold. Maybe related parties you will have a lower threshold. For other parties you can have a higher threshold and start verifying what is the nature of the advance and whether what kind of transactions and settlement period is mentioned in the terms of contract. So basis that you will have to perform audit procedures.
And this we have to perform during the entire year, not on the closing balances.
Uh, yes, technically yes, but because the reporting is outstanding balance at the balance sheet date, a more practical approach would be, to see the balances at the year end, then see whether they are in the nature of loan or not.
Right. One or two hands have been raised on the previous clause, which I've
Yes.
seen now. Can I ask them to raise
Yeah,
their voice?
sure.
So, Anita Kumari, I've allowed you to talk. Anita ji and Shankar Jha. Please raise your query if you want. Both are unmute. Both are to unmute themselves and raise query.
Hello.
Shankar ji, yeah, Shankar ji.
Yeah, namaskaram, Jain sahab. Basically, yeah, I have to ask, say, in the case of, say, personal guarantee of the directors, okay,
Yes,
for a loan in which he has even mortgaged his property for the loan of the company, okay, still it remains unsecured in your views?
Yes, sir. Because as long as the company's own property is not given as a security, the company cannot treat the loan as secured.
No,
And
definitely
personal
directors
guarantee
are.
always is unsecured. Even banks are not treating them secured if it is only personal guarantee.
No, there is no only personal guarantee, sir.
Yeah.
Basically, directors have mortgaged their property in favor of the bank.
Got
Yeah.
it. Whenever there's a property mortgage, which is of director only, banks will insist of personal guarantee. Otherwise, also banks insist of personal guarantee. What I said is, so we concluded earlier, and we've seen also in the guidance note that whenever security, the property belongs not to the company, but to the directors and other parties. Then for the company balance sheet, those advances, those loans, borrowings have to be treated as unsecured, which Pranav ji said. And what you said is, if it is a personal guarantee along with the property of the director, I don't think it will change the scenario.
Yeah, it will not. So, I understand your concern, sir. I think the problem is because it's very difficult to convince the client the security is property of the director. The bank is not at a loss. So why it is unsecured? Because once you classify it unsecured, there are a lot of other issues that can come up with the bank. Right. So that is a challenge, but I think guidance note can be a handy tool, to convince the client, which clearly mentions as I also showed. So paragraph 8 point.
Yeah, you have referred that
3.1.14.
paragraph.
Yeah. So that you can always refer to the client that this is what the insured is saying. So we cannot go and let me give another example. Now, let's say you have taken a loan of 100 crores, right? And you company has secured its own property, right? But the value of the property is 80 crores. Now, if you go strictly by the guidance note, only 80 crores can be shown as secured. 20 crores still would have to be shown as unsecured.
Okay.
No, but
Because
every day, sir, you cannot take the valuation of the property. Certainly, at
True.
the moment in time when the company has mortgaged its property in favor of the bank, they have taken the valuation. Okay, and it is expected that the valuation may have increased, and we cannot take and arrange. Client
I
can arrange
agree.
a valuation.
So you go by the book values, right? So see that. So now let me link it to this clause number 1, which talks about revaluation. So what was happening was the book value of the security was lower and the bank loan was higher, right? So the companies were continuously, what they were doing, banks were asking the companies, and companies were, getting it revalued on a selective basis. Okay, this property is mortgage, so let's revalue it and show it more than the amount of the loan. The banks were happy, the company was happy. So that triggered one, a change in the accounting standard, even the Indian GAAP, which said that you cannot do a revaluation on a selective basis. If you have to do revaluation, you do revaluation for the entire class. So if land
Yeah,
is
yeah, yeah.
revalued, right? So you revalue all land, and then you cannot say it's a one-time exercise. You decide that you would need to revalue at a particular interval. So that is what triggered this. And now they have put it into CARO. See the objective of CARO. So CARO, if you start linking CARO with Schedule 3 requirement, that is the objective. Why are you revaluation doing more than 10%? Just so why they're asking? Because that would have a direct impact on the security of the loan. So that is why a lot of things have come in. So I agree that it's not possible to revalue on a daily basis, and nobody is asking to do that. So you see at the balance sheet date what is the value of the security as per the books of accounts, and what is the loan, and then do a reporting.
And one more question is coming. Say, if you are, say, even I am basically accepting the guidelines given by the Institute of Chartered Accountant of India, but still a question arises. Say, if the company goes into liquidation, and say some that IBC process is started against the company, then what will be the treatment? Why the IBC's proceedings is going to be started with the against the Mr. Anil Ambani and all? They have given the personal guarantee. Okay, so when you are not showing even a secured loan and a security in the books of account of the company, it may create a trouble. Say, God forbid, if company goes into liquidation and say the IBC proceedings commence against the company. What is your opinion about this?
So let me. I think there have been certain, changes to IBC regarding, personal guarantees and all that. So I'm not going to that. But see, if a charge has not been created on the property of the company, right? So it will be a property. So let's take an example that there is a property of 100 crores, right, available with the company, but which has not been pledged for the loans taken by the company. The loans have been taken on the basis security by group companies or directors. Now, this 100 crores, no charge has been created. So even in insolvency, I think that if we read Companies Act, I don't remember the exact section. So it clearly mentions that no particular lender can proceed against that property unless charge has been created. So in case of insolvency, what will happen is it will be open to all the lenders, secured lenders, in equal proportion of their loans, right? If it is a secured first charge, then the person in whose favor the first charge has been created would get a first right on the proceeds of that property in case of liquidation. That I think is very clear.
For the distribution of liquidation proceeds, there is a separate section in the IBC.
Yeah.
Okay, and that is called waterfall mechanism, and section 53 of the IBC, and the proceeds from that will be distributed against the as per the provisions of section 53. Okay,
right.
So, but I am not going to nitty gritty of the IBC. There is $1 million question which I am trying to raise before you, sir. That when in spite of the security and personal guarantee of the directors and mortgage on the property, if you are showing in the financial statement that it is an unsecured loan, the first sight of information which the insolvency professional who is going to be appointed, he is going to get the information from the financial statement of the company.
Yes.
The financial statement.
Shankarji, let me add to it. There has to be Pranavji,
Yes.
I'm so sorry, I've stopped.
No.
Although as we were concluding earlier that it has to be shown as unsecured borrowing as far as company is concerned. However, there has to be a note that this borrowing is secured against personal guarantee of so and so person, as well as mortgage of the property which belongs to this particular director or this particular company or the third person. So that,
do you not think that
that particular information has to be there.
Yes, yes. So let me just
Definitely, I appreciate that, but
right, right.
again,
So let me reopen that guidance note. So it says when promoters or other holders or any third party have given any personal security or borrowing, such as shares or other assets held by disclosure should be made thereof. So, but that security does not result in classification of such borrowing as secured. So disclosure is required. So what all property, personal guarantee of any other person have been, given as mortgage or pledge, that disclosure has to be given, right? So yes, it appears very unconvincing to show that despite so much security, it's unsecured. But this is how the things stand actually.
Just a minute, sir. Let me take a pic of that particular
Guidance note, yes, sure, sir. I will just
yes, that particular clause.
yes, sir, please.
8.31.4.
Yes,
I'll send this to all, sir.
yes.
Thank you.
Shankarji, I fully appreciate your concern, but unfortunately, this is what the guidance note says, and I think this has been discussed by me at various forums and even in the auditing standard board. But this is how the position stands actually.
no,
And
sir. This is a humble submission. We are not on the forum of the institute. You are representing us on the various forum. You can raise our concern before the committee who is doing the changes in the guidance note.
Right.
rightly said, Shankarji. One more question, Pranavji. You said that we have to take book value. Rightly said that if it is a 100 crores loan and property valuation is 80 crores. 80 crores you meant by book value or the market value? Book value, of course.
Yeah. Yes, sir, book value.
Okay, and always market value of the property is higher, and banks are giving lending against that higher market
Yeah.
value.
So there can be one option, although we have not come across any such case. If you have done a fair valuation at a very recent date, maybe you can give a disclosure and maybe as a very footnote in the borrowing that it has been considered secured because of the present market value being based on a valuation done by a registered valuer, which you may not record in the books of account because you are following a cost model, but that can be done.
Right. So, which means that we need to really ask all the companies and the directors to have a copy of sanction letter as well as the valuation report of all the properties which they have given to the banks.
Yes. Yes.
So that proper disclosure can be done in the whether secured or unsecured hardly matters, but below that or in notes of accounts certain informations can be incorporated that this particular unsecured or secured borrowings are secured against this particular property which
Right.
has been valued by the registered value on this particular date to be this much value.
Right. Absolutely right.
थैंक यू सर. एक और इसमें आया था हाउ क्लासिफिकेशन इज टू बी डन in case company has given indemnity or counter guarantee to director promoter for their security. Company okay.
Right. What I understand is the company, the promoters have pledged their this thing
Property and the guarantee.
property,
And company
and
has
the
given the
company.
counter guarantee.
So a disclosure would be required, but again, that would not change the characteristic of the loan because that property is not secured. The loan is not secured in the property of the company. So you're just given a guarantee or an indemnity bond or something.
And I don't think banks are allowed. There is a specific clause that banks will not, while giving sanction, they do have a condition that companies will not give indemnity bond or counter guarantee to the directors who are giving personal guarantees or mortgaging their personal properties. So this is, I don't think it is there. Please, sir.
Right. So we discussed this clause 3. We discussed what are the advances in the nature of loans. So reporting is required for all loans and advances to any party, not just related parties in the earlier version. And advance in the nature of loan. Okay, loan given in cash or in kind, reporting is required. where the loan has been squared up during the year, again, the same has to be reported. Guarantees to cover financial guarantees only, and there are certain sections of the Companies Act which the auditor needs to ensure compliance with. Okay, clause 3B, whether the investment made, guarantee provided or security given, and the terms and conditions of grant of all loans and advances in the nature of loans advances and guarantee provided are not prejudicial to the company's interest. So basically, they are talking whether, the terms and conditions are not prejudicial. So maybe, you have given loans at a very substantial low rate, or, you have given guarantee for a sick company, which is not even a going concern. So these would be, considered prejudicial. And just to add one thing, with clause 3 earlier, even the employee loans are covered. So if your company is giving loans to its employees as per the policy, even that needs to be, examined by the auditor and reported upon. In guidance note has very clearly mentioned that also.
What is to be done there? It
So
is
you have to,
generally repayable in 2-3 months of 6 months of installment.
So whatever, so this clause 3 covers employee loans also, whether their terms have been stipulated, whether they are regular. In case of overdue, you have to report that so many cases are overdue. So that entire clause 3 is applicable to employee loans also, because it does not exclude employee loans specifically.
Okay.
The next is in respect of loans and advances, the nature of loans, whether the schedule of repayment of principal and payment of interest has been stipulated, and whether the repayments or receipts are regular. So basically, what was happening was there were a lot of companies, where the loans were given without any terms and conditions, and they were generally repayable on demand. So, even if the company was not getting its money back, so it was never reported. And more so, particularly, when the company has taken loans and also, given loans to other group companies. And so to highlight those cases, they said you have to specify whether the repayment terms have been mentioned, and whether these are regular or not. And if they are not, then what is the amount overdue for more than 90 days, and whether reasonable steps have been taken by the company for the recovery of principal and interest. So the term regular actually means the date when the principal and interest are to be received when they fall due. So there is generally a date associated for the payment of interest and repayment of principal. So if it is not done on that particular date, it is not regular.
When there's no repayment terms, then on
So you have
demand,
to, so you have to mention that the terms of repayment have not been
prescribed.
specified, right? So now on repayment on demand, we come to the next clause. Actually, I think there's one clause which specifically mentions that whether they are in the repayment of demand. So I will come to the F, 3F, right? So this is a very interesting clause. Now, what we discussed in the early beginning itself. So whether any loan advance in the nature of loan granted which has fallen due during the year has been renewed or extended, or fresh loans granted to settle the overdues of existing loans given to same party. If so, specify the aggregate amount of such dues renewed or extended or settled by fresh loans, and the percentage of the aggregate to the total loans and advances in the nature of loans granted during the year. So basically, this was evergreen that was happening. So you give loans to a related party, and the related party is unable to pay, so you give fresh loan. The old loan is settled through a new loan, or uh, so you extend the period. Okay, not pay on 31st March 22, you can pay up to 31st March 23. So to get these things onto the main report, so they said they inserted this clause and said you need to actually report such cases. So the evergreening principles, would come out in the open. So
One
next,
more question, Pranav ji, whether the secured, unsecured, which was being discussed earlier, it relates to all companies, whether CARO or applicable or not.
yes, because see, secured unsecured is not coming from CARO actually. So secured unsecured is coming from Schedule 3 to the Companies Act. So you have to classify, something as secured or unsecured. Now, the basic principles would apply to all companies, irrespective whether CARO is applicable or not. Right.
Sanjeev Shiv Kapoor is asking whether related party advance during the year is nil at the year end. What to do?
Right. So, nil at the year end. So, first of all, the first clause is whether in the year the company has granted loans or not. So, there, it would be reported, right? Then, then again at the year end is not there. So, there's six sub clauses. So, you'll have to see, whether the reporting is required as at the balance sheet date or at any point during the year. So, if it is clause 3A, main clause, it is any time during the year, so that reporting would be there. So now this question that you were asking, sir, about repayable on demand, right? Uh, so this they have addressed to clause 3F. So whether the company has granted any loans or advances in the nature of loans, either repayable on demand or without specifying any terms or period of repayment. If so, specify the aggregate amount percentage thereof to total loans granted. Aggregate amount of loan granted to promoters, related parties are defined in clause 76 of section 2 of the Companies Act. So basically, again, the risk is related parties and promoters. So what they have done is first they ask you whether there were any loans which were repayable on demand or where no terms or conditions were specified. And if there are such cases, you give the amount of percentage of the loans given to promoters and related parties as defined in the Companies Act, section 2, subsection 76. So this reporting will take care of your question that you were asking if there are people on demand.
Right, sir.
Okay. So this again is a very minor change as compared to previous year. Earlier, earlier CARO version was restricted to deposits. Now they have included term deemed deposits also. So if they are deemed deposits, then this reporting would require to be done for deemed deposits also.
Sir, one question here. I'm sorry, I'm
No problem.
diverting the matter. Presently, we're all filing DPT3 for all the companies.
Yeah.
So, besides secured and unsecured advances,
yes,
there's normally one other figure which is being reported is advance from customers which are there as on the balance sheet date or March 22, which is beyond 365 days.
Right, sir.
This is to be reported and this is to be taken as deposits. And what are the repercussions if at all these advances are there? In brief.
Sir, the provisions of section 73, 76 will trigger, and there would be penalty provisions that might be leveled because then you are accepting deposits, and it has got significant consequences. So that again is a very vast subject to discuss actually.
I know.
So all the RBI guidelines and all these things will come into place because
but
that
it generally happens that there are out of 100, under 200 customers, 1 or 2 customers have given advance and they are still at advance even after 365 days, or part of that is there.
So that would again, you see that one is if the say for example something has to be provided after 2 years, right? Some service or machinery or product has to be provided after 2 years, then 365 days will not trigger actually, right? So you have to see the terms of contract. So say for example rental deposits. So rental deposits, even though they're outstanding for more than 365 days, they are not deposit because that's as per the terms of agreement, rent agreement. That yes, it's a security deposit till the continuation of the lease agreement. So similarly, if there is a contract where you have to supply maybe something very it takes substantial period of time, and you have to supply those goods after 365 days, that will again out of it. But if it has not been refunded and the period was only 3 months or 6 months, then that is a problem. So the company law is very clear on that. Rules are very clear. What is deemed deposit and what is not deemed deposit.
Say, for example, one amount is given, and after that, whatever supplies are made, bill to bill payment is coming, and the original earlier amount which is received is still outstanding. And if you really go by aging bill to bill principles, then this amount is outstanding for more than 365 days.
So is it a security deposit or something
No.
sort of something?
No.
See, most of the practically what most of the companies are doing is they are writing it back and taking it as income to avoid falling under the purview of deemed deposit.
Okay. Right, sir.
This is the practical approach most of the companies are doing. And believe me, that the 2-3 years after this deposit rules have come in, a lot of companies have started, analyzing their old advances and either settling them or writing them back after assessing whether these are actually repayable or not. Because
Okay.
that's a legacy problem in many companies actually.
Right, sir.
Statutory dues, again, there is one change in particularly, two changes rather. One, GST has been included. Earlier, GST was not there in CARO 2016. And second change in clause 7B, earlier the disputed demands were related only to income tax, excise, customs, and sales tax, basically tax related. Now, what they have done is they have covered all statutory dues. So, even if PF or ESI or professional tax, any such dues also disputed, then that has to be reported. So the change they have made is now the language they have used is whether the statutory dues referred to in subclause A have not been deposited on account of any dispute. Earlier, the language was disputes, statutory dues in respect of income tax, custom duty, excise duty, service tax, etc. So that is the only change. So no additional change in this clause. Unrecorded transactions. So again, this requires whether any transactions not recorded in the books of account have been surrendered or disclosed as income during the year in the tax assessment under Income Tax Act 1961. If so, whether previously unrecorded income has been properly recorded in the books of account during the year. So this is a new requirement. So word surrendered or disclosed implies voluntary addition of such income. This can be demonstrated on the basis of returns filed and the statement made during the certain survey. Reporting is not applicable where the addition is made by the income tax department and the company has disputed such additions. So the auditor should review the tax assessment made subsequent to the balance sheet date, but prior to the signing of auditor's report, if the surrendered or disclosed income relates to the year under audit of prior years. Proper recording would mean proper disclosure in the financial statements. The auditor also needs to evaluate whether disclosure of such income as exceptional or extraordinary item under AS5 for non-Indian companies or application of India's 8 for correction of prohibited item for India's companies. Now, as far as Schedule 3 is required, there is an exemption where immunity has been given from disclosure, so companies may not disclose. But as such, this clause under CARO does not talk about any immunity thing. But the guidance note being devised by the institute will try to address this point.
Sir, lots of questions were there. I mean, there are still there in the fraternity, wherein section 68, 69 additions are made by AOs and huge additions are done. Now, whether those additions, say undisclosed income or undisclosed funds available, whether these are to be included in the books of account, and if yes, then what could be the second leg of it? One is, say, suppose cash is found.
Yeah.
So cash is added to the cash in hand, and the next leg has to be income only.
Income only.
But questions are there whether or not to include in this. If you really include, that would mean that it was there and we accept that it was there.
Right. So that is any
And
case
at times, just to buy peace, we actually do not litigate on that issue.
Yeah, I understand that, sir. But if we have already offered or they have this thing, they have added back and we have not disputed, right? So one reporting is triggered only when you have voluntarily said कि this is what I am surrendering. Now, if they have added back, the question is how to account for in the books of accounts, right? So if we have assessed that it is your cash, so I think you have to take it on the books of account with adequate
You
disclosure.
should take in the books of account on the date of final assessment.
Yeah, because see, otherwise, what would happen? 3 years down the line, same cash would again be treated as undisclosed.
Undisclosed. Okay, got it. You have answered very, disputed question being raised by so many of us.
Right. So next particular clause is borrowing that again has got 6 sub clauses, significantly enhanced reporting requirements and perhaps rightly so from the perspective of the government that with so many defaults happening. So I'll quickly run through this because we are short of time. So
Sir, time, if you permit, we can increase. Not an
not a
issue.
problem. Not
Yeah.
a problem, sir. Not a problem.
Sanjeev has again said if taken in books of account, this undisclosed income, section 68, 69 or whatever, then what account would be created in books, and is rightly asking because it is already been taken as income by the AO or whatever CIT appeal and all. Now, if we bring it in books of account, another leg, if it is income, then it would be tax again. So it has to be, if it is partnership, proprietorship, it's okay, we can take it to capital. But what about companies? Is it to be taken to reserves?
I'll have to check this. I will really get back to you on this because right now I don't have any
Right, sir.
right now I
Right,
have
sir.
answer. Right. So coming to borrowing, so one major change is earlier, the restricted, it was restricted to banks, financial institutions, government. Now it has been enhanced to cover loans or borrowing or interest to any lender. So even if you take from a related party or promoter or shareholder, anybody, the borrowing clause is triggered. Right. So that is a very significant enhancement in the reporting requirements. So the first clause is whether the company is defaulted in repayment of loans or other borrowings or in the payment of interest thereon to any lender. If yes, the period and amount of default to be reported as well as format below. So the format has also been specified in the CARO order. So this is straightforward. So nature of the borrowing, name of the lender, and amount not due on due date, whether principal or interest, number of days delay or unpaid, and remarks if any. Right. So default again would mean non-payment of dues on the last day specified in the loan documents or the debenture trust deed. Right. So auditor has to report defaults committed during the year and the number of days of default and amount remaining unpaid, period and amount of all defaults existing at the balance sheet date, irrespective of when those defaults have occurred. So some defaults are carrying forward from the previous year, but outstanding of the balance sheet date that also needs to be reported. So the one important question is where the company has applied for reschedulement or restructuring in case of defaults. So here the guidance very clearly says if the restructuring has been done before the year end, then the default stands rectified. Whereas if the restructuring or rescheduling has been done after the balance sheet date, the reporting has to be done, but the auditor can add a remark in the last column that the loan has been subsequently rescheduled or restructured. 9B, whether the company is declared a willful defaulter by any bank or financial institution or other lender. So the reporting is required whether the company has been declared a willful defaulter by any bank or financial institution or any other lender. Now, in this regard, the guidance note has clarified that banks and financial institutions are very clear. So any other lender can be a very wide term. So anybody can go ahead and declare the other party a willful defaulter. So To avoid this, they have said the other lender should be restricted to government or government authorities because they have power under the law to declare a company as a willful defaulter. So individuals are excluded from the definition of other lender as per the guidance note clarified issued by the institute. Right. So as a part of audit procedures, when obtaining balance confirmations, the auditor can add a question whether the company has been declared as a willful defaulter. The guidance note prescribes that you can, check websites of credit information companies, RBI, and other information available in public domain to verify whether the company has been declared a willful defaulter. A parallel reporting requirement under Schedule 3 is also there. 9C, whether term loans were applied for the purposes for which the loans were obtained. If not, the amount of loans are diverted and the purpose for which it was used may be reported. So clause was there, some modification has been done to the existing clause. Now, auditor is also required to examine whether the loans were applied for the purpose for which the loans were obtained and where the loans were not applied for the purpose for which these loans were obtained, report the amount of loans were diverted and the purpose for which it is used. So there is additional requirement of amount to diverted and the purpose for which it was being used. So term loans from any entity, person other than bank, financial also to be examined because it is not limited to term loans from banks or financial institutions. It just says term loans. So if you have taken term loan from a group company or a person, individual, that is also covered under this reporting. So RBI circular defines what is the diversion of funds. This RBI circular definition has been reproduced in the guidance note issued by the institute. So the auditor needs to examine the purpose and for which the loan was taken and its utilization. So such process includes checking whether the company has granted loan to other parties, including related parties, or made investment in other companies. Where the company has temporarily used the funds for purposes other than for which it was taken, it is quite possible you have taken loan for starting a project and the project is starting maybe after 3 months or 4 months. So temporarily you park the funds in some investments. So that fact also needs to be reported that temporarily the company has used the funds for this purpose. Where the general purpose loans, so we have to evaluate from the perspective whether there has been diversion of funds as defined in the RBI circular. So there are certain restrictions which the RBI circular prescribes that you cannot use even the general purpose loans for. So that has to be assessed. Clause 9D, whether the funds raised on short-term basis have been utilized for long-term purposes. If yes, the nature and amount to be indicated. So this clause was earlier in CARO 2003, which was deleted in subsequent clause CARO 2015 and 2016 also they have reinstated. Basically, the objective is to ensure the companies are not using short-term funds for long-term purposes because that's not a good financial management practice. And normally when there are liquidity issues, only then you would use your working capital limits or short-term funds for acquiring fixed assets, and so there would be a mismatch between your borrowings and utilization, and you may not be able to repay your short-term borrowings well in time. So that was the objective of bringing in this clause. So the auditor should evaluate the overall sources of funds and application of funds. They review the cash flow statement. The cash flow statement generally give you an idea where the financing activities are happening and where the investing activities are happening and how much funds are being generated from operating activities. So basis that you have to make an assessment. So where the long-term funds are significantly less than long-term application of funds. So maybe companies largely funded by working capital loans, and there have been significant additions to fixed assets. So and there no much profit from the operations also. So it would normally indicate that the company has used short-term funds for acquiring long-term assets. Typically, a current ratio of less than 1 would be such indication. Clause 9E, whether the company has taken any fund from any entity or person on account of or to meet the obligation of its subsidiaries, associates, or joint ventures. If so, details thereof with nature of transactions and the amount in each case. So basically, if a company is taking funds from another person, and which is for the purpose of meeting the obligation of its subsidiaries, associates, or joint ventures. So basically, what it means is a subsidiary company has to repay its loan, but is unable to do so, and the holding company borrows funds and repays the loan of subsidiary. So this reporting will be triggered. So you have to give the details of the nature of the transaction and the amount in each case. So basically, the objective of introducing this clause is uh, to ascertain, how a company is already in losses, and that is being indirectly funded through banks, not through a holding company. So they want to identify such cases. So you have to obtain list of all subsidiaries, associates, obtain list details of loans, advances granted to these entities. So and obviously compliance with AS 18 or India's 24 and standard operating 550 related parties have to be performed. And the funds in this case would include both long-term funds and short-term funds. 9F, uh, whether the company has raised loans during the year on the pledge of securities held in subsidiaries, joint venture, or associate company. If so, give details thereof and also report if the company has defaulted in the repayment of such loans raised. So, reporting is required only if loans have been raised during the year on the pledge of securities held in subsidiaries, associates, or joint venture company. That includes if you have pledged the shares of your subsidiary company, your investment in subsidiary companies, the shares you are holding, you have pledged that. Then it is the case where you have paid loan, but with the securities. Now, securities is not restricted to equity shares or preference shares. There is a very wide definition which has been reproduced in the guidance note. So, I mean, like, just not restrict yourself to equity or preference shares or debentures. So there's a very vast definition which is reproduced from actually Securities Contract Regulation Act (SCRA). And further, if there has been a default in repayment of loans obtained by pledger security, that has to be reported. So the guidance note has clarified a few things. Reporting to cover all loans taken during the year from any lender, so not restricted to banks or financial institutions, any lender, even if these have been repaid during the year. Reporting is required only in case of loan taken during the year. Therefore, loans taken in earlier years and outstanding at the balance sheet date need not be reported. Default would include both repayment of principal and interest. So again, for clause 9A, you have already checked the default has been there or not. So procedures are already performed. So you don't have to actually repeat the procedures. You just have to verify whether those loans were against the pledge of securities in subsidiary, joint venture, or associate company. And the format for reporting has been specified in the guidance note that reporting format can be used for reporting. Fund raised by way of IPO of other public offering. So this clause was already there along with the term loan. So as such, there is no enhanced of reporting requirement. So they have basically split term loans into separate clause, clause 9, and IPO remains as it is. So auditor has to ensure compliance with the offer document for the purpose for which the loans have been taken, and also consider the SEBI regulations in this regard. Preferential allotment, private placement, again, there is only a slight modification to the existing clause as per CARO 2016. Previously, only a reference to section 42 for private placement was there. Now, they have included section 62, which discusses preferential allotment. So, as such, there is no change from the previous version. So, not going into the details. So, there are other clauses where I would like to spend a little more time. Fraud. So this has been significantly enhanced. So earlier, 2016, CARO required the reporting only where any fraud by the company or any fraud on the company by its officers or employees has been noticed or reported in the year. Now the reporting is a fraud committed by the company and on the company by anyone. So earlier only frauds on the company by its officer employees were covered. Now If anybody has done any fraud on the company, that needs to be reported. So auditor's scope is restricted to first noticed or reported during the year. So as such, the guidance will also clarify the auditor is not supposed to go for fraud hunting. In any case, principles of SA 240 issued by the institute need to be followed. Auditor has to maintain professional skepticism, and if he notices or comes across any fraud which has been reported, that needs to be uh, disclosed in this clause. Use of word notice or reported indicate the management of the company should have knowledge about the fraud by the company or on the company that are occurred during the period covered by the auditor's report. The auditor to report established frauds, only those frauds which have been established where there are any suspected or alleged frauds. So the auditor is not required to report. However, that would have an impact on the audit procedures and the scope of testing that the auditor would be required to perform. Because if there are suspected or alleged fraud, obviously it would require a reassessment of risk or material misstatement due to fraud, and additional procedures may be required, including enhanced preventive procedures or control testing. That I've already covered. Guidance note requires auditors to consider principles of materiality as per standard in auditing. So obviously, when reporting under this clause, the auditor needs to consider materiality. Another reporting requirement is filing a report under section 143.12. So 143.12 refers to reporting of fraud by the statutory auditors and others in form ADT 4. So reporting, so basically this requires the auditor to obtain copies of form ADT 4 filed and verify uh, the fraud reporting that has already been done, and basis the audit evidence they have to report under clause 11b whether any report under section sub 12 of section 143 of Companies Act has been filed by the auditors in the form ADT 4 as prescribed under Rule 13 of the Companies Audit and Auditors Rule 2014 is a sinking form. Whistleblower complaints, again, this is a new reporting requirement. So basically, this requires the auditor to consider whether any whistleblower complaints have been received during the year by the company, and if yes, they have to state that they have considered the whistleblower complaints. So when I say auditors is considered, that would mean not only reporting on fraud, but also have an impact on the audit procedures. So if there are whistleblower complaint that there are malpractices happening in procurement process, so the auditor would have to take cognizance of such a whistleblower report, and reassess the risk of material statement, maybe enhance the audit procedures, relook at the materiality levels that are to be used, and perform a detailed control testing. So this could have an impact on the audit procedures, definitely. So this is what the intention of this clause is, besides just the mere reporting. Now, listed companies are required by SEBI, LODR, and also Companies Act to have a vigil mechanism or a whistleblower mechanism, where people can freely communicate their concerns about illegal or unethical practices. Section 177, subsection 9 of the Companies Act requires every listed company and companies accepting deposits from public and companies which have borrowed money from bank and financial institutions in excess of 50 crore rupees to establish a vigil mechanism for the directors and employees to report the genuine concerns or grievances. So you have to check whether vigil mechanism is applicable to a particular company or not. If yes, you would need to see the reports. If a whistleblower mechanism is not mandatory, so the auditor would require, the guidance would requires the auditor to obtain from management all whistleblower complaints that have been received and review such reports. The next one I've already covered. The auditor should also obtain a representation letter. The auditor is not required to consider whistleblower complaints pertaining to earlier years while reporting under this clause, and principles of materiality to be applied. Internal audit system, again, this is a reintroduction of clause which was earlier in CARO 2003. Now, certain companies are required to have an internal audit function. So basically, all listed companies are required to have an internal audit function. Besides that, Private companies, unlisted private companies, their turnover is more than 200 crores, or loans from bank or public financial institutions is more than 100 crores. And unlisted public companies, where paid up capital is more than 50 crores, turnover is more than 200 crores, loans from bank and public financial institutions is more than 100 crores, or outstanding deposits are more than 25 crores, are mandatorily required to have an internal audit function. So where the company is required to have an internal audit function and does not have, the auditor would have to state the fact. Where the company has an internal audit system, the auditor has to report whether the system is commensurate with the size and nature of its business. And where the companies are not required to have an internal audit system but have voluntarily adopted a system, again reporting under this clause will be triggered, right? And where it is not required and not have, the auditor should state that fact.
सर वो लिमिट्स एक बार दोबारा बता दें.
See, all listed companies without any limits, and then unlisted public companies, right? So paid up capital greater than or equal to 50 crores, turnover greater than or equal to 200 crores, loan from banks and public financial institutions greater than or equal to 100 crores, and outstanding deposits greater than or equal to 25 crores. And this limits have to be checked at the end of the previous financial year.
Okay.
And in case of private companies, there are only two conditions: turnover greater than 200 crores, and loans from banks and public financial institutions of greater than or equal to 100 crores. Right. Now, where there is an internal audit system, the auditor has to consider reports issued by the internal auditor, right, before the conclusion of audit and finalization of the audit report. The guidance note clarifies that auditors should consider all internal audit report covering up to the end of the financial year internal audit. The auditor to consider all report that is shared till the date of audit. The auditor should include this requirement engagement letter and agree with those charges governance that will be relying on the work of the internal auditor. The auditor has right to receive full-fledged internal audit report, including draft and not just the executive summary. So, certain companies, listed companies, only a executive summary is presented before the audit committee, and the detailed report is not shared. So the auditor should ask for a detailed internal audit report and not just the executive summary, because the details are in the main report. Executive summary is just a highlight of key points, right? Then the auditor should agree with the internal auditor also and management about the timing of completion of internal audit and receipt of periodic reports from the internal auditor. Evaluate the control deficiencies pointed out by the internal auditor while reporting on internal controls of financial reporting. Very important thing, there is a standard on auditing SA 610 which has been revised, that is using the work of internal auditor. So there are certain principles mentioned in that standard. So while relying on the work of the internal auditor, the auditor should have due consideration of the guidance given in SA 610. Where the internal audit reports are not available or provided short notice or scope is not adequate, the auditor should consider the impact on reporting under this clause and also reporting under internal controls over financial reporting. I think some hands are being raised.
Let me see, sir. They were earlier, sir.
Okay.
One was Mr. Shankar Jha, and Satyaprakash said, he wanted to unmute.
Okay.
To mute rather, yeah.
Right.
And if somebody wants to really come and ask, please come in chat box and give me directions.
Right. The next is cash losses. Again, this is a repeat from CARO 2003 with slight modification. Now the clause says whether the company has incurred cash losses in the financial year and the immediately preceding financial year. If so, state the amount of cash losses. So in CARO 2003, there was a caveat that if the company is registered for less than 5 years, the reporting was not required. So basically, the objective was in the startup companies or in the gestation period was considered to be 5 years, and they said ki up to 5 years, if you are incurring cash losses, you do not report under this clause. But however, they have removed the term 5 years now. Even in the first year, if you are incurring cash losses, the reporting is triggered. Right. So auditor to report whether the company has incurred cash losses during the period and in the immediately preceding financial year. So 2 years. So it could be possible in the current year there are cash losses, in the previous year there were no cash losses, or vice versa. So you have to draft your audit report accordingly. The guidance note clarifies that it is not appropriate to consider just the cash flows from operating activities as cash flow statement, as per cash flow statement for the purpose of this clause, because items such as interest expense and interest income are also relevant for determining the cash losses.
So
cash,
what would be the cash loss then?
yeah, so they say ki you start with a net profit or loss after tax and adjust it for transactions of non-cash nature such as depreciation, amortization, etc. So instead of just taking the cash flow from operating activities, you just start with the PAT and then keep adding back non-cash adjustments like bad debts written off, maybe impairment provisions or depreciation and amortization. So these to be added. So that would give you the cash profit or cash loss.
Right, sir.
Next is very important. So figure of cash loss has to be adjusted for the effect of qualification. Now let me give you an example. So a cash profit, as explained above, before considering the impact of qualification is rupees 10 lakhs. And there is a qualification of the auditor that the company has not recorded a provision for doubtful debts for rupees 20 lakh, even though these are fully irrecoverable. Now, if I take the effect of these 20 lakhs, so my net result would be a net cash loss of 10 lakhs actually. So I have to take the effect of qualifications also, and then determine whether it's a cash loss or a cash profit. And I have to report a quantum of cash losses incurred in the CARO report. So it says whether the company has incurred cash losses, and if so, state the amount of cash losses. So you have to consider that. Resignation of statutory auditors. So there were cases where a lot of statutory auditors have started resigning, especially from listed companies due to increased regulatory scrutiny. So, and the reason that was being given was no time availability or preoccupation with some other work. So in this context, the institute also came out with a guidance note, or not a guidance note, implementation guide for the audit procedures or the procedures to be performed by the outgoing auditor, and which required again a detailed explanation and not just the fact that I have other work to do, right? So there has to be a justification. And so in many cases the auditors were resigning because of conflict with the management or unethical practices, or they were not allowed to qualify the reports, and they started also mentioning this in the resignation letter and form 83 that was being filed. So the objective of introducing this clause was that the incoming auditor should be, aware that the previous statutory auditor resigned, and why the previous statutory auditor resigned, and what were the concerns raised by such previous auditor, and whether the incoming auditor has taken into consideration those issues, objections, or concern that the previous auditor raised while resigning from the company as a statutory auditor. So this was the objective, and this is the procedure that has to be followed. So the company or the auditor should obtain ADT filed, and in Exhibit A, in case of listed company, and consider the reason for resignation. Also read the last issued audit report or review report to understand the modifications and assess the potential impact of reasons for resignation on his or her strategy, audit strategy, and reporting. Material.
It means if the reason given, what you said, the preoccupation, no time or whatever, or no reason is given, then the incoming auditor is to do what?
So the incoming auditor would report that there were no, basically they have considered there were no issues or concerns raised by the outgoing auditor as mentioned.
Okay.
There were no, so there could be some very genuine reasons. So I will give you some practical examples, where, the company is going for an IPO, right? And one of the requirement of ICDA guidelines is that the audit has last 2 years or 3 years has to be done by a peer reviewed auditor. And that previous auditor was not a peer reviewed auditor. So he has no option, but to resign. And in most cases the subsidiaries also, the main company wants the same auditor, particularly in case of IPO. So there could be genuine reasons, that the outgoing auditor can clearly mention the company is going for IPO, which is required to be a peer reviewed auditor, and being not eligible, I'm resigning. So there could be very genuine reasons also.
Satyaprakash ji says he should take consultant with previous auditor.
Yeah, so basically, the auditor, see, in any case, the incoming auditor has to send a request for NOC to the previous auditor, right? And that very clearly requires you to mention whether there are any reasons for which we should not accept this assignment. So that is a consultation only, actually. So the outgoing auditor has to respond as per code of ethics. Incoming auditor also has to require NOC as per code of ethics, and the outgoing auditor should also respond as a courtesy and code of ethics. So that consultation is already there, actually. So next clause, clause 19, which is again a very big clause to read, actually. So let's read it. On the basis of the financial ratios, aging and expected dates of realization of financial assets and payment of financial liabilities, other information accompanying the financial statements, the auditor's knowledge of the board of directors and management plans, whether the auditor is of the opinion that no material uncertainty exists as on the date of audit report, a company is capable of meeting its liabilities existing at the date of the balance sheet, and as and when they are fall due within a period of 1 year from the balance sheet. So let's break this requirement into sub points. So the opinion to be formed is no material uncertainty exists as on the date of the audit report. So if I am issuing the audit report on 25th June, so I have to make this assessment today. And what assessment? That the company is capable of meeting its liabilities existing at the balance sheet date. So I have to say whether the liabilities which were existing on 31st March 2022, that the company will be able to repay within a period of 1 year from the balance sheet date. So by 31st March 2023, if there are any liabilities due, the company would be able to repay those, and this assessment I am making on the date of audit report. In making this opinion, the auditor shall consider financial ratios, such as liquidity ratios, current ratios, acid test ratio, cash ratio, uh, aging and expected dates of realization of financial assets and payment of financial liabilities, other information accompanying the financial statements. Now, the exposure draft to the guidance note being revised clearly mentions that other information should be read in the context of SA 720 only, because otherwise there is no end to the other information. And lastly, auditors' knowledge of board of directors and management plan. So, as part of audit procedures, you do have discussion with board of directors, management, and you are privy to the knowledge of the plans, what is going on in the company, any expansion, any new fresh loan being taken, or new issue being planned. So that also, auditors should consider while forming an opinion on this clause. So financial assets and financial liabilities are defined in India 32 and AS 20. So definitions can be referred from there. The emphasis on the company's ability to meet its liability and not on going concern. So it may happen. The auditor may conclude that a company is a going concern based on certain factors like comfort letter from the parent company, significant orders that may happen in the near future, or a proposal for restructuring of loans and liabilities, so loans from bank which have been restructured, or some period has been rescheduled. So basis a lot of factors, a company may be a going concern but still have inability to meet its liability within a period of 1 year. So there has to be a distinction between the reporting under this clause and going concern, although there would be definitely certain overlapping. So in many cases, there would be overlap. So test of existence of material certainty is to be done on the date of audit report for the position of liabilities existing at the date of balance sheet. Liabilities to be examined should exist at the balance sheet date and due for payment within 1 year. This should be distinguished from current liabilities, which are classified based on operating cycle. So, to elaborate, maybe a company has an operating cycle of 3 years. So, certain liabilities which are due within 1 year which are due within 2 years or 3 years would also be classified as current liability. Right. So you don't pick up where the operating cycle is 1 year, there is no issue. Where the operating cycle is more than 1 year, certain liability which are fallen due after 1 year are also shown as current liability. So the auditor should obtain a schedule for repayment of liabilities and examine the liabilities which are due for payment within 1 year. So there has to be a very, where particularly in some companies, real estate or construction companies, operating cycle would be more than 1 year. So care has to be taken. To the extent relevant, the auditor should consider the guidance given in SA 570 going concern and the implementation guide on SA 570 and perform adequate procedures. Uh, the guidance will also mention that if it is expected a liability is due within a year, based on holding company's letter of support, the fact should be stated whether it may happen that a holding company or a group company has given a comfort letter that all the liabilities falling due within 1 year will be paid by us. So the company is not capable, but still they have a comfort letter and the parent company is capable of meeting those liabilities. The auditor should mention this fact in the CARO clause. Schedule 3 to the company that also requires disclosure for certain ratios. So the auditor may consider these ratios or other ratios as considered appropriate to make assessment for reporting under this clause. It is not necessary to establish a one-to-one relationship between unpaid liabilities and realizable financial assets. This evaluation should be done on an overall basis. Guidance notes suggest a negative assurance. So if you read the guidance note, it says, based on our examination, nothing has come to our attention that causes us to believe that a company will not be able to pay its liabilities fall due within 1 year. So they have not given us straight opinion. They have said nothing has come to attention. And then they have added a caveat that this assessment is made on the audit report and there may be circumstances of event that may happen beyond the audit report, which may result in the company not being able to meet the liability. So I think the guidance note has very appropriately limited the liability of the auditor for reporting under this particular clause. And where the auditor concludes that material uncertainty exists, the auditor should assess the impact on the main audit report, considering the guidance in SA 570 going concern. So, as per SA 570, a separate paragraph is required, material uncertainty related to going concern information. So, that also needs to be considered. Corporate social responsibility, again, there is a parallel reporting requirement in Schedule 3 also. Basically, there are two clauses where the auditor is required to comment. First is other than ongoing projects. So, in case of other than ongoing projects, the company is required to transfer the unspent amount within 6 months from the expiry of the financial year to a fund specified in Schedule 7. In case of ongoing project, the company is required to transfer the unspent amount in a separate bank account as per section 135 subsection 6 of the Companies Act. In both the cases, the company should record a provision in the books of accounts as per AS 29 or NDS 37. Uh, because that liability now will crystallize, because in case of other than ongoing project, since the company is mandatorily required to transfer the fund, they have to actually book the expenditure, record a provision for payable to the fund. I'm not going into the details of the compliances of this section. This is the reporting requirement. Another important reporting requirement, which is again a new reporting requirement and applicable only on consolidated financial statements, is clause 21, which says whether there have been any qualification or adverse remark by the respective auditors in the company's auditor report of the companies, including the consolidated financial statement. If yes, indicate the details of the companies and the paragraph number of the CARO report containing the qualification or adverse remarks. So this clause is applicable only in case of consolidated financial statements. So where a company is in the standalone financial statements, no reporting is required for this particular clause. In case of audit report on consolidated financial statement, this clause has to be given. So there are two ways of reporting. Some auditors are giving an annexure by giving a reference in the main report at like we do in the standard financial statement, the other legal requirements paragraph. And in some cases, the auditor is including comment within the main audit report itself. So both practices are available. So the auditor can choose either of the two. And the requirement is to give only the paragraph number of the CARO report containing qualification adverse mark of the components. There is no need to reproduce the text of those paragraphs. So, for example, if there is an adverse reporting for fraud in case of subsidiary company, so the auditor would mention only uh, name of the company, SIN number, clause paragraph number 12. That's it. You don't have to reproduce the paragraph that has been given by the auditor of the component. Because the requirement is to give the paragraph number of all the companies, including the consolidated financial statements. So the guidance note has clarified that the CARO comments given in the standalone audit report CARO also have to be reproduced. So if you as a principal auditor have given some adverse comments on CARO in the standalone audit report, so even the paragraph numbers of those qualifications or adverse marks have to be given in this consolidated financial statements. There could be a case where the component auditor has not issued the statutory audit report by the date of the principal auditor's report, and say for example, for the purpose of consolidation, the subsidiary auditor may have given a special audit report to comply with the requirements of the group audit instructions or for the purpose of consolidation only, because they have time till 30th September to file their audit reports. So in such cases, the auditor should report that the component auditor has still not issued the statutory report and state this fact. Another important point, this reporting is required only in respect of entities, including the consolidated functions, to whom CARO 2020 is applicable. So if there are foreign subsidiaries which are also consolidated, CARO is not applicable to those foreign subsidiaries. So it is not required by the principal auditor to ask the auditors of such foreign subsidiary to issue a CARO report. It is not required. Only to the companies where CARO is applicable and reports have been received would be considered for the purpose of reporting under clause 21. And the reporting required is name of the component, SIN number, relationship, and clause number of the CARO, which has adverse or qualification report. Some minor changes in the clause 16 regarding NBFCs and housing financing companies. Earlier, there was only one clause which has been reproduced in CARO 2020 also, which said whether the company is required to be registered under Section 45(1)(a) of the Reserve Bank of India Act And if so, whether the registration has been obtained. So three new sub clauses have been added to this particular clause. One, whether the company has conducted any non-banking financial or housing financing activities without a valid certificate of registration from the Reserve Bank of India. So if you are doing any NBFC of housing finance activity, you need to hold a valid certificate of registration, and that is what is required to be reported under this clause. Uh, Whether the company is a core investment company as defined in regulations by RBI, and if so, whether it continues to fulfill the criteria of a CIC, and in case of company which is exempted or unrestricted CIC, whether it continues to fulfill such criteria. So, where you have registered as a CIC, the auditor is required to report whether the company continues to fulfill the criteria of the CIC. And certain companies are exempted from being registered as CIC, particularly where the net owned funds are less than 100 crores. So, in such cases, the auditor should comment whether the unrestricted CIC continues to fulfill the criteria for exemption for registration. And lastly, whether the group has more than one CIC as a part of the group, indicate the number of CICs which are part of the group. So the group they have defined as holding company, subsidiary, associate, common brand name. So these are the criteria which they have defined for group. So if there are more than one CICs in the group, we have to report the number. So these were the additional requirements for NBFC and HFCs. That's all from my side. I have not covered all the other clauses because
Thank you, Pranavji. Very elaborately, you have covered all the major changes, as well as the questions raised by the members, including myself, which were at times not related to CARO, related matters, but not specifically for the CARO. And we have gained, particularly, I have gained 2-3 things like secured, unsecured borrowings, and there are lot many others. I'm requesting members, if they have any query, quickly they can ask. I know Pranavji, as is already crossed almost 3 hours of continuous
not an issue,
speaking.
sir. Not an
So,
issue, sir. So I can see one question. I think Mr. Satyawal Gupta ji has raised the question. Ratio calculated by auditor differ with the director report. What will do?
yeah.
Right. So ideally, they should not differ because the guidance note has prescribed, various formula for calculating ratios. The director should also consider the same formula. Why? Because see, auditor is not giving any ratio. So auditor is verifying the ratios given in Schedule 3 by the company. So Schedule 3 disclosure is the responsibility of the management, and director report is also the responsibility of the management. So they cannot have different ratios or the same criteria. I mean, like they cannot have different numbers of the same ratio at two different places. So ideally, it should not be there.
Right. So if there is any other question, members, please ask very quickly. I'll request Pranavji to answer. And in case of no question, we have to close this session. So no more questions, sir. So which means either we have all understood what you explained, or whenever we'll undergo those areas of audits and reporting, then only we'll have those queries, and those questions will raise definitely yes at that moment of time. Meanwhile, thank you very much, Pranavji, for such a wonderful and elaborate discussions you had for our members. And thanks all the members who joined. This recording will be shared on YouTube. Please again look at this. I mean, listen to this recordings whenever you have certain queries, which will answer all your problems. Thank you very much. Bye bye.
Thank you, sir.